Hello, my name is Michael Landsberg, Chief Investment Officer of Landsberg Bennett, Private Wealth Management. Welcome to our fourth quarter market update. I'll take about 10 or 15 minutes just to kind of walk through what we see in the marketplace and talk a little bit about our positioning in this environment. First is rates. We've all seen interest rates move higher, and part of that's been the fact that I think the market has lost some faith in the Federal Reserve to do their job. If you remember in the summer, Chairman Powell said that he's going to be looking very closely at the data to determine whether or not to raise rates. Well, the data seemingly went straight up from there. We see that in the pumps. Gas has moved higher, food prices have moved higher. Then for whatever reason in September, he decided not to raise rates. Well, the bond market looked at that and thought, that doesn't make any sense. So the bond market took rates up for them. You've actually heard them now say, oh, we don't have to raise rates because the market's done it. Yeah, the market's doing their job for them because the market ultimately believes that inflation will continue to go higher. That's why the positioning, and we'll talk about that, is for higher rates. Whether the Fed raises them or not, we're going to still continue to see them. It gets back to inflation. We think inflation is reaccelerating. Again, I mentioned that going to the pumps, going to buy food. You're seeing that kind of happen. What's interesting is you'll see the Fed and government officials try to spin it and say inflation's not accelerating. Not sure either A, they're not seeing what we're seeing, or B, they're lying. I'm going to go with they're hopefully not seeing what we're seeing and not the other. But obviously, anybody paying attention, inflation's reaccelerating. Now, do we think it'll reaccelerate back to where it was a year ago? I don't think so. But the idea that it's going to be at 2% anytime soon is a stretch. 2%, if you remember, is the target the Fed uses as kind of their goal. And they'll probably continue to look at either raising rates or have the bond market do their work for them until you start to see it come down. There was hope in the marketplace, not on our part, but on other people's, that, hey, inflation will get to be in the 2s by the end of this year, and they'll start cutting rates next year. We don't really see that. We see inflation staying here higher, a little higher than longer. And really the only way we see an interest rate cut is if we go into a big, deep recession. So obviously we're not hoping for a cut anytime soon, because that would mean the economy is in much worse shape than it is. So interest rates to continue higher, inflation's to continue higher. So what do you do in that environment? Well, there's quite a few things that we do. We've positioned the portfolios to do that. Let's talk about what you don't want to do. You don't want to own utilities. You don't want to own real estate when rates are going higher, especially when they've started to reaccelerate. So you'll notice in the portfolios, we don't own any utilities. We don't own any real estate. In fact, we own a fund that bets against the price of real estate, particularly commercial real estate, which we think is going to have a big problem. Logically, if you understand commercial real estate, mortgages are from 5 to 7 years in the commercial mortgage space. Nobody gets a 30-year mortgage like we have at super low rates. So they got it 5 to 7 years ago when the world was a different place. Pre-COVID, everybody went to work. Post-COVID, nobody really wants to show up anymore. So you've got occupancy rates much lower than they were 4 and 5 years ago. And interest rates have gone up a lot. So when somebody has a building and they had a 3% mortgage for 7 years, and now it resets and now they're looking at 7 or 8%, and their occupancy has also declined, that's going to pose a problem for these real estate companies that own big office space, as well as some of the regional banks that lent those folks money. So we want to stay away from those. So you see us with no exposure to regional banks as well. So those are the things that we want to not own, or in the case of real estate, we want to bet against. The stuff that we do want to own is stuff that goes up when inflation starts to reaccelerate. That would be oil. That would be the US dollar. And in fact, actually own a fund that makes money when interest rates go up. It's kind of the opposite of bonds. Because really what's happening now is rates go up, it puts a cap on what the stock market can go to. And part of that reason is you're going to get 5+% in cash. Our money market's paying 5% now. So you start to see that as competition for stocks. So specifically areas like utilities where there's not a lot of growth, you start to see, well, do I take the risk of the stock market, or do I want to lock in some rates that are higher in terms of cash? We're not locking in any longer term rates because we think rates will continue to go higher. And obviously you're starting to see a bond sell-off, meaning interest rates are going up, prices are going down. We've been immune to that because we basically only own, for our bond positions, cash or very short-term treasuries that don't move around a lot. That's been on purpose. And we think that'll continue to be a good place to be until rates at some point stop going higher. Then we can have a discussion about where we want to go with that. At the end of the day, we want to look still for companies that are growing their businesses, again, in the sectors that aren't going to be particularly hurt. which would be, for example, tech and healthcare. Energy, I mentioned, is an area that we like. And again, staying away from utilities, staying away from real estate, staying away from the places that are going to be affected by some of these places, home builders. Where obviously right now with a 30-year mortgage at 8%, not a lot of people buying new houses unless you're paying cash. So it has that ability to do that. Diversification-wise, we've been talking about it. Some of the best places to invest right now are not in the U.S. Our core position, for example, has been dividend stocks for a lot of folks, but our satellites have started to own some things like India, like Japan, where there's growth there, but there's not a super high interest rate that's hurting stocks. We'll continue to see that as an area to be positive on, as well as a diversification. What we did last year was we had the shorts or the inverses to mitigate the damage. So when things were falling, we weren't falling as much. What we've done this year is we've started to move slowly, and we've finally gotten there, is to look at alternatives, not just stocks and bonds, but commodities, currencies, things like that move differently than stocks and bonds. And for example, in the last couple of weeks, as stocks have fallen and bonds have fallen, some of those other asset classes have risen. And that's important to be able to have, for example, when oil's going higher, that's going to hurt some companies, but we own oil, so that's going to help us be able to offset some of that. So that diversification is very, very important. The traditional 60-40 portfolio that you hear about on TV doesn't have these other asset classes. So it's been basically going down. It went down a lot last year, and it started to go down now as stocks have rolled over. What people, I think, don't realize at this point is the S&P 500, when I look at every single stock, the 500 stocks, and equally weigh them, meaning one's not higher than the other, they're negative for the year. The reason stocks are higher as an index level is there's 7 stocks, and you kind of know the ones, the Magnificent 7, that are up on average about 100%. Now, we own the majority of those, but we don't own 40% of your portfolio in that. We own 1 and 2 and 3% of each of those positions, not 6, 7, and 9% of those. So those have basically driven the market, and as they've started to fall in the last month or two, you start to see the index come back down. Small cap is negative for the year, as well as some of the other major indices. So the market itself hasn't really had a great year. It's those handful of stocks, and what we're starting to see is they're getting tired. They're getting kind of tired of carrying the weight, and we're starting to see that roll over a bit. That's why the diversification is so important, to not just own those 7 stocks, because the volatility is starting to pick up in those names. We haven't seen volatility like this, as we've seen in the last week, since the end of 2018, and that's something that we're watching. So in summary, what we're looking for is we're looking for rates to continue to kind of tweak higher, inflation, unfortunately, to go higher as the price of oil goes higher, notwithstanding what happens in the Middle East. I'm not making a call on whether the situation in Israel broadens to other parts of the Middle East, but obviously anytime things get worrisome in the world, the price of oil seems to rise. So that's we were owning it on a fundamental basis, but now geopolitically we think it makes sense to own that. And again, when we have some additional cash, we're getting paid on the cash. So we're in no rush here. I think right now it's a choppy period of time. Hopefully we'll get some resolution out of Washington regarding the House. That's not helping us in terms of investing with no clarity as to who's going to be the leader of the House. And those are things obviously that put a little bit of stress on the market. So again, we appreciate the opportunity to chat with you a little bit, share with you kind of our thoughts on where the market is and how our positioning for the next quarter is going to go. Thanks again for the trust and confidence you place in our team. Hope you have an enjoyable holiday season. Thanks again.